Hi everyone and welcome to this Morningstar webinar. My name is Nigel Silito from Insight Discovery and I have the great pleasure of hosting this event, and I'm pleased to say the response has been pretty incredible. We've had over 150 registering for this event and we currently have about 45 people watching online. So thank you very much for your participation today, and I'm pleased to say we have a really good lineup of speakers and panelists. And I'd like to welcome, starting from the bottom, Gavin Kaur, who is MD and Manager of Selection Services at Morningstar. Gavin's basically responsible for producing investment solutions for institutional investors around the world, including model portfolios. And prior to Morningstar, Gavin was a fund manager at BlackRock, and he's basically been in this industry for quite a few decades, and he's currently working from home in lovely Somerset. So welcome, Gavin. And above Gavin on the screen is Oliver Kettlewell, who is Head of Fixed Income and Global Multi-Asset at Mashreq Capital, which has an office in the DIFC. And I believe you're currently working from the office. You're one of those rare people, Oliver.
That's correct. I've braved it and come into the office today, yes.
Congratulations. And finally, at the top, we have Simone Ichgowski. Hopefully I've pronounced that correctly, Simone.
Correct. Thank you.
Lovely. Thank you. Who is fund manager of the asset management team at Abu Dhabi Commercial Bank. And two things which Oliver and Simone have in common is that they both work for well-known local banks, and also many years ago they actually worked for Morningstar. So what we have today is a collection of Morningstar-ites. And so thank you very much for being part of this live debate. And do please send in your questions for our lineup of experts today. And Gavin's very kindly agreed to kick things off with a presentation which covers topics such as which investment styles have performed best during COVID-19, is ESG proving its mettle, or is it just a fad? And then afterwards we will open it up to a debate with Oliver and Simone. So yeah, please do send over your questions, and over to you, Gavin.
Okay, well, I'm just going to turn this on to presentation mode. So good morning, everybody, and it's a great pleasure to have the opportunity to talk to you all this morning in these extraordinary times. So as Nigel says, I'm just going to set a little bit of the scene of what happened over the course of this year so far. And the answer is it has been the most extraordinary period that any of us in the investment industry have ever seen. This slide here is an interesting one. Not only is it pretty with and busy, it's also interesting in that this shows those periods when the markets have fallen by 25% or more, back as far as the data as we can get. And what this shows is that if you think about the Great Depression, 1929, it took nearly 50 days for the market to fall 25%. And yet in February 2020, with the COVID crisis and the fact that the global economy effectively went into a forced coma by governments and central banks, the market reacted in a unprecedented and speedy fashion in terms of reflecting significant concerns that they had very quickly. And of course, this is an environment for fund managers. It makes it almost impossible to manage this type of environment in a dynamic fashion. Whatever the position was, whatever the position of your portfolio was at the beginning of the year, effectively you had to ride out this very furious and fast storm. And it was effectively a rolling of the dice. Nigel mentioned that I was a fund manager for many, many years. We used to use a phrase called see you on the other side trade, which meant that you effectively, you were unable to influence your investment positioning, and you just had to see how it panned out. And that was certainly the case in the first quarter of this year. So an extraordinary period, very volatile, a very significant sell-off in risk assets, and it happened very quickly. Now, this slide here is an interesting one. Once again, busy, and let me explain it. What this shows is back to 2000, the minimum and maximum periods for various asset classes. So how well have they done in the best quarterly period? How badly have they done in the worst particular period? And that's those red bars. So for instance, it shows that the best ever quarter that gold had was up 18%, and the worst it ever had was down 22% or so. And what this shows is government bonds on the left and equities on the right. And in the blue and the brown bars, it shows what happened in the first quarter being brown and what happened in the second quarter being in blue. And so this shows that there was a dramatic polarization and difference between the performance of risk assets, namely equities and credit, versus safe haven assets such as government bonds and gold. And so what we saw was very stable and in fact positive performance from government bonds as people fled to safety, whereas at the riskier end of markets, we saw dramatic falls in the first quarter. And so, for example, if we look at emerging market debt here, if we look at global high yield, if we look at European equities, UK equities, US equities, they posted effectively their worst or close to their worst ever quarters in terms of performance. Interestingly, GCC, Sharia, and Sukuk actually performed relatively well in that regard. But then what we saw after the dramatic interventions by central banks and governments with unprecedented monetary and fiscal stimulus, which resulted in markets beginning to believe that the authorities would lessen the impact of the COVID pandemic. We saw a rally from late March through to the end of the second quarter, which once again was unprecedented in terms of its strength. And so you'll see here that in US equities, in the second quarter, it posted the best ever quarter it's posted since 2000. What this once again demonstrates is how incredibly difficult this was for fund managers, let alone retail investors, to actually position their portfolios and manage it. It showed that if whatever changes you made to your portfolio in the first quarter would have a dramatic impact on performance in the second quarter. It also demonstrates something that we at Morningstar are very keen to help our clients and to help educate the end investor about, which is the importance of behavioral finance, the importance of not selling at the lows, to take away some of those behaviors that can often result in a deterioration in your ultimate performance. So the best thing that you could have done as a retail investor was to effectively go on holiday, if you could go on holiday in the first 6 months, or certainly not touch your investment portfolio. So having a long-term mindset, having a long-term view has definitely been beneficial to investors through this first half. It's also why we at Morningstar, when we are researching fund managers and looking at fund managers, we are always keen to make sure that those managers have a rigorous process, have a clear risk controls and portfolio construction disciplines, and that they can manage their portfolios through this period. So in summary, a very, very difficult period, very volatile, and a dramatic difference in performance between different asset classes. So this slide here shows you how actually some of the things that we saw during the COVID pandemic effectively it resulted in the pandemic did not result in a reversal of trends. In fact, if anything, it resulted in a continuation of trends. And one of the most significant themes in markets over the last 3 years, since 2014, but particularly since 2017, has been the outperformance of growth investments, and by that, and growth as an investment style compared to value investing. And by that I mean that style, growth investing, is where investors are looking for companies or industries that are demonstrating secular growth trends, where they are benefiting from new technology, they're benefiting from new business models, and where they are not necessarily dependent on the underlying level of economic growth. So they're not economically cyclical. And we saw this in 2017, 18, 19, and during the first quarter, we saw once again a dramatic outperformance of growth as a style. And the greatest example of that are the large technology companies. If we think of Amazon, if we think of Alphabet, if we think of Netflix, the semiconductor stocks, companies that were perceived to be actually beneficiaries of the COVID pandemic, beneficiaries of the digital economy, beneficiaries of people working from home, for instance, they performed extremely strongly, healthcare companies. Whereas actually we saw companies that were exposed to the auto sector, the airline sector, tourism, retail, more value-oriented sectors performing very, very badly indeed. And so when we saw this economic shock in the first quarter, where the global economy went into an economic coma, many commentators were expecting there to be some reversal in the leadership of style in the market, and that has not been the case. And in fact, it got worse, or these trends were exacerbated. So what this chart shows us is during the first half of this year, when we saw economic growth expectations fall dramatically, we saw that the value sectors, those economically sensitive areas of the market that were arguably on lower valuations, fell even further than those more highly valued new economy, digital or healthcare type sectors. So value managers who've had a very bad previous 3 years actually had a difficult first quarter. And then what was really interesting in the second quarter was how well actually in the recovery, how investors actually started pouring money not into the unloved sectors that had performed most poorly, but actually continued to buy those industries and sectors that they believed would be immune to the economic effects of this pandemic and would benefit from a changing world, a new digital economy. And so we see once again from the lows of the end of March, growth as a style outperforming, which is the blue line, outperforming the large cap value sector, which is the green line, which was very interesting indeed as a theme. Now, related to that is the growth of ESG, environmental, social, and governance, or sustainability investing. And what's been interesting, as you will all know, is because of the climate crisis and other issues, there has been a dramatic increase in the amount of money flowing into ESG funds or sustainable funds, partly driven by regulation, particularly in Europe, but also driven just by changing consumer attitudes and a fear of, for instance, climate change. And so the performance of those sustainable sectors, sustainable industries, has been quite dramatic over the last 18 months. But during the turbulence of the first quarter, what we saw was this the sustainability outperformance actually continued. And this is reflected in the Morningstar Global Markets, our Sustainable Leaders Index. And this shows the outperformance of that Morningstar Index over the broader, wider markets. And what this shows is that investors, not only do they want to invest sustainably, but they also observed that during the first quarter, as growth sectors were outperforming, that actually their ESG funds were performing better than other funds and better than the market. And so there was an incentive again to pour more money into those areas of the market, into sustainability, as opposed to other areas of the market. And if we think about sustainability, most funds, and this also applies to Sharia funds in many ways, they're not exposed to areas of the market such as autos, the aerospace industry, metals and mining, energy as a sector, sectors that perform very badly. And yet they were exposed to healthcare, IT, some of the new economy type sectors. And so we saw a aligning of the stars between growth investing and sustainability as a style, which has been incredibly powerful. And the flows of monies we've seen in our Morningstar data into sustainable funds has been dramatic, capturing the most new assets out there. So this is a theme that has demonstrated it's not only it is something that is attractive to investors, but it's also demonstrated that it can outperform in turbulent and volatile markets for the time being. So one of the things that we've been thinking about is how does COVID and this pandemic, what does it mean for the economy? What does it mean for markets going forward? And the reality is the COVID pandemic has effectively pushed and opened the door on existing trends that were already there. So the trend of climate crisis, which resulted in the growth of sustainability that I mentioned, that resulted in less travel, lower consumption, changing working patterns. Well, obviously, COVID has resulted in that being dramatically accelerated. People are working from home; they're not commuting to work. People are consuming less. People are doing less. Tourism has collapsed. These were things that were already beginning to be important in terms of the markets and in terms of investing, and the crisis has only accelerated that. And that, of course, has significant sector implications. So will the airline industry recover to where it was in the past? Will the tourism industry change? Will the property sector, office space, will they ever recover to the levels they were at? Or will this result in a permanent and structural change to how those industries operate? And then if we think of inequality, the Trump effect, Brexit, some of the populism for instance, in Brazil or in Latin America, that has been driven by a sense of inequality post the financial crisis. And there was already talk of redistribution of wealth, a populist agenda, bigger state involvement, and all of that leading to political uncertainty. And this COVID crisis has once again accelerated those trends. And the one thing we can say with some certainty is that political uncertainty is only going to continue. And we can certainly say that the state is going to have much greater involvement in the global economy than it had in the past. And you can see that even in the most capitalist of countries, such as the US or the UK. And the third large trend that was happening, which obviously had a significant impact on markets over the last number of years, has been an anti-globalization agenda, which has been driven by trade wars with China and the US, but generally a feeling that globalization had gone too far. There was an increased reliance that people were thinking about the dangers of long supply chains. And so COVID has highlighted that again, where having shorter supply chains, having greater self-reliance, being able to have your own food supply, your own pharmaceutical supply, being able to produce your own PPE, being able to produce your own cars, all of these type of trends are beginning to accelerate again. And so trade wars, which had been a theme and concerns of that, that's not going away. And once again, that has implications for countries and sectors. So the auto industry, Germany as an example, which has been a major beneficiary of global growth. How does that fare over the next 10 years when we see a reversal of globalization? And so one of the other points to note as an industry perspective is that the crisis has also magnified the pressures on our industry, and I'm sure on your business as well. We already had the pressure of regulatory pressure, so MiFID II, Solvency II, some of the ESG regulation coming out of Europe. All of that was placing significant pressure on firms, institutions, obliging them to improve their governance processes, their investment capabilities, their oversight capabilities. Those pressures, if anything, have been accelerated again by COVID, where the regulators are asking the questions on institutions as to whether they have been able to cope with this crisis. Profitability pressure. We know that AUM has been in decline. We know that margins are under pressure. And once again, the crisis is focusing institutions on their cost base, on their core capabilities. What bits should they do themselves? What bits should they, for instance, outsource? And finally, the digital economy. We know that digitalization has been critically important. We know that fintech is becoming a threat. And what this pandemic has accelerated is the need of an institution to be able to have a digital business model, to have digital content, to be able to engage with their clients in a digital fashion, and to be able to cope with changing consumer preferences, whether it's ESG, whether it's sustainability, whether it's better reporting or content. So the crisis has magnified those pressures on the industry. And so finally, the question, the multi-trillion-dollar question is, what type of recovery do we see? And of course, we'll talk about this in the Q&A in a minute. But there are many expectations of a V-shaped recovery, a U-shaped recovery, an L-shaped recovery, which doesn't constitute a recovery at all, a SAW recovery with multiple peaks and troughs. And so to some degree, nobody knows. And it's like throwing a dart at a dartboard, that there is considerable uncertainty, and it's very difficult to know what that recovery is going to be. We have unprecedented central bank and government stimulus. Monetary and fiscal policy has never been looser. We know the implications of QE. It is resulting in certain asset classes just continuing to go up with sometimes negative yields. And so the question is, where next? Certainly in terms of our research, we know that the returns that investors are likely to get going forward are likely to be lower than we've seen in the past, certainly across the fixed income spectrum. And the one thing we can say is that doing detailed research, understanding the investments you're investing in, understanding the fund managers you're investing in, is going to be utterly critical. As I've shown throughout these previous slides, there are many industries that will never recover from this, and there are many industries that have already benefited from it. Understanding the fund managers, understanding the investment horizon, and having the right amount of research there is going to be critical going forward. So I'm going to pause. That's 15 minutes or so of a backdrop, and I'm going to pass it back to Nigel to open up to a Q&A with that backdrop.
Great. That's brilliant. Thank you so much for that, Gavin. Just before we open it up, I should explain we did a survey amongst the fund selectors in the Middle East, still ongoing. But if I look at the initial results, and I'll just quickly read out some of the answers. One question was post-COVID-19 challenges. What concerns you most about the current environment? And the top pick was costs. The drop in investment returns means we will have to cut operating costs. That was by 43% of the respondents. Another question was about long-term investment planning. What is most important to enhancing your investment performance? And the top answer was implementing modern data analysis / artificial intelligence. That was 41%. And then there was also a question about the industry outlook. Which of these would you most like to see over the coming 5 to 10 years? And the top pick was cheaper external asset management, particularly in alternatives. So gents, as I've got you all live on screen at the moment, what are your initial thoughts to the answers to this very short pulse survey, which we will publish quite soon? Maybe I can kick off with Simone at the top.
Sure. Look, I don't think neither of those answers really come as a surprise. And it's a bit what Gavin said. I think COVID has only accelerated some of the trends we've seen. The industry has been already under the cost pressure. Margins have been lower. Investors are much more informed, so they want better value for money. And of course, there is disruption of the industry from things such as AI and different types of technologies. So of course, there's a pressure on costs. And the same with your last point about cost of active funds or it was alternative products. Again, I mean, we've seen that trends pretty much globally. Pressure from passive funds on active funds to deliver better value for money. So I don't think any of that really comes as a surprise.
Okay, no problem. And Oliver, what about you?
Yeah, sure. So if I take your point about operating costs being an issue for a lot of people at the same time as we're expecting lower returns in the future. So we're effectively in our industry, we're being hit by double whammy in that respect. So I think it's really important. One of the easiest things to do to mitigate this is to just simply stay invested. I think, as Gavin pointed out, if you had panicked on the 23rd of March and you had cashed out of your portfolio, your client's portfolio, you wouldn't have benefited from the rally that we've seen in Q2. So I think staying invested, just being invested in anything during the second quarter would have helped your client regain some of the losses that they've made year to date. And it would have helped you as an advisor or as a fund selector probably earn some money with fees for managing your client's portfolio. And then just one other point you made about alternative investing. So I think one of the response was that alternatives are becoming more popular, more important. And I think that will continue to be the case because of the lower forecasted returns for stocks and for bonds, because the valuations of these two core asset classes are less attractive going forward. So I see these trends continuing.
Okay, great. Well, questions, I'm pleased to say, are coming in left, right, and centre. So I've got a question. We're going to open it up now for Gavin. This is from UTI International. He's asking, as supply chain disruptions underpinned by trade wars are further exacerbated by accelerating deglobalization in a post-pandemic world, where do you see pockets of opportunities in terms of geographic and asset classes?
So unsatisfactorily for you, I won't necessarily forecast who the beneficiaries are, because actually there's this we can probably already see that in the stock markets and bond markets. Certainly the sectors that we see performing well, they're sort of intuitive that they're benefiting from this pandemic. But it strikes me that there is a almost conscious decoupling between the West in general, certainly the US and increasingly the UK and Europe, away from China. So that will have significant unraveling effects in terms of the supply chain. We've got an announcement coming, I think, today in the UK about Huawei and its use within the UK telecoms industry, for instance. Listening to the chief executive of BT yesterday, he reckons that will take between 7 and 10 years to unravel, to extricate Huawei and to put in Ericsson and Nokia kit. So these type of things are going to take a decade to try and make individual countries and certainly regions more independent from their global trade competitors. For instance, in reaction to the U.S. actions recently, in terms of the abilities of U.S. semiconductor companies supplying into China, the Chinese are developing rapidly their own semiconductor industry to try and to have an alternative source of supply. So this is happening very, very quickly. I would imagine the most of the tension will happen between China and the West. Whether European or US companies will be happy outsourcing to Southeast Asian economies, Vietnam, Thailand, etc., I don't know. So I can't give you the answer to that. What I can say is that the decoupling and unraveling of trade lines does have significant positive impacts for developed economies as they bring manufacturing back home.
Okay, great, thank you. This is a question for Oliver. When we spoke the other day, Oliver, you mentioned that you'd lost faith in active managers, and I believe you're now switching 100% to passive. Could you just expand on this? And I'd love to hear Simon's attitude to the passive-active debate. So, Oliver, if you kick off with this quite controversial question.
Sure thing. So yeah, you're completely right, Nigel. I've lost faith in active fund managers, particularly for developed markets. And I say this having been starting my career at Morningstar as an analyst, largely covering active fund managers for half my career. And I think that's the only time when active fund management makes sense, or analysis and fund selection of active managers makes sense, is if you can dedicate 100% of your time to it. In terms of due diligence, and that's means screening, on-site visits for the fund managers, poring over prospectuses, and which I know that Morningstar does all of that very well. But I think if you're a local fund selector for a bank, a family office or an insurance platform. We all have a million other things to do here in terms of regulatory reporting and whatnot. So I think it's very difficult to keep on top of it from a time management perspective relative to a passive. But the final point I'd make, and actually the main reason why I favor passives now, is just the statistics. Because passive statistically outperform the average active fund manager, particularly for those core asset classes of US equity and developed market government bonds. And I feel as though this trend is only going to continue with the Fed saying that they're explicitly going to buy ETFs, for example, corporate bond ETFs and the like. So I just feel as though there's a limit now to the value of doing this active fund manager research.
Okay, Simone, are you going to come to the defense of active managers? What's your strategy at ADCB?
Sure. Well, I don't think it's ever white or black, right? And we are probably somewhere in the middle. So I think both active and passive can play an important role in portfolios. And that's how we manage our portfolios. So we do have a small bias toward passive funds. It's about 60-40% allocations passive versus active. But clearly there is a place for both. So we would go for active, of course, in the case of the more efficient asset classes Oliver was referring to. If you want to play maybe a beta, it's a tactical call for liquidity reasons. But there are still a number of asset classes where active fund managers can add value. I think what you need to do is, if you go for active fund managers, you need to make sure you don't go for those index trackers. But you really go for products that for funds that are run with a high conviction and got enough flexibility to really be able to justify these fees. But Oli also make a very important point that, of course, the reason maybe we're having often this discussion is because of the resources. We all know that in terms of risk and returns, most of that comes from a strategic asset allocation. We also know that a lot of our time will go into servicing clients. So if you take all those components into account and you are constrained on resources, Oliver is probably right. If you have to choose between those three, maybe there are better places for you to add value. But if you can dedicate, then I would still justify going active and passive.
So Nigel, can I come in here and tie up some of the points raised there? I think so. I agree entirely with some of the basic premises of Oliver and Shimon. But what I would say is, and I've been an active manager for many years, there has never been a better opportunity, arguably, for active managers to do well. Time will tell, but for the reasons I mentioned earlier on about the growth of ESG, the fact that some industries will just not survive the way they were surviving, the ability, if you are clever enough and if you have the resources enough, and if, as Oliver says, you have the ability to spend enough time as a fund manager analyzing these trends, the ability to pick those winners and avoid those industries that are negatively impacted. I think the polarization in sector performance that we have seen should be a good opportunity for active managers, perhaps. However, at Morningstar, we have been a significant advocate and favored passive investing across many asset classes. We have changed our ratings processes recently to shine a light on the fees that many funds charge, which make it very difficult for active managers to outperform. My final point I would make, which I think both of my co-panelists have mentioned, is it is hard work doing fund analysis. It is hard work choosing fund managers. And part of our whole raison d'etre, our business model within my business unit, Morningstar, is to help those institutions in picking those right managers and making sure they have time to focus on their core business.
Great, all good points, thank you. Let's just quickly ask about Sharia, because it hasn't been loved recently, and I know this is one of your pet subjects, Oliver. So are Sharia funds a competitor to ESG, and what's your stance within Mashreq Capital?
Yeah, sure. So the biased opinion of myself would be that you could definitely see Sharia in the same light as ESG, because what is ESG? As Gavin said, it's screening out companies which are harmful to society, which aren't doing society much good. So that's screening out weapons manufacturers, tobacco, gambling, and for Sharia also alcohol. So a lot of the characteristics of Sharia are the same as ESG, and in some ways, at a stretch, you could even say that in this part of the world, we've been pioneers in ESG, because Sharia funds have been around for 10, 15 years, long before the ESG acronym was coined, really. So I think that Sharia definitely has a place as a competitor alongside ESG. And even if you think about ESG, it's still quite new, whereas the average, say, Sukuk fund has returned 7% over the last 10 years. So that's a pretty decent return to have for a Islamic investment, and I think that would compare favorably to an ESG.
Okay, great. Actually, I've just had a question from Nicola, and this is maybe for you, Simone, because obviously you like active managers, or more so than Oliver. Is there an opportunity for active management to demonstrate value with ESG?
Good one. I think that's probably how ESG started. It has been initially a domain of active fund managers. I think the passive product have been playing a catch-up game. It's, I think, the same trend we've probably seen in a broader space. I would say yes, that active funds probably have more tools as always to incorporate the different ESG screens. I don't think ESG has one name or one face, so they have a better ability to incorporate some of those screens. Yeah.
Okay, great. And this is a question that's just come in for Oliver. What's your opinion on European high yield versus US high yield?
The short answer is either. It doesn't matter. They're both going to be good, because at the end of the day, the Fed, as I said, has said they're going to buy high yield bonds at double B, which contains some big household names such as Ford. And I suspect the ECB will join the party too soon and start explicitly buying more corporate bonds, whether it's IG or the highest realm of high yield. The one additional point I'd make to that, the US versus Europe, is that actually if you look to EM high yield, EM high yield does offer some very attractive valuations, particularly for yield-hungry investors relative to the US and Europe these days, because central banks keep gobbling up these corporate bonds. The yields are less attractive. So maybe also look to EM for that yield pickup.
Okay, great. Another question is just coming. We've only got about 5 minutes left, unfortunately. This applies to all of you. What are the top 3 qualitative and top 3 quantitative factors that you look for when selecting a fund manager? Maybe Simone, you can kick off with that.
Sure. Well, one of them is conviction. For sure, you want a fund manager to have a courage of conviction if you're paying him an active fees. At the same time, I think you want you want fund manager to be humble. We all do mistakes, and I like when a fund manager do recognize that and in fact is able to learn from those mistakes. So definitely these are two of the criteria, I would say. And the second part, you say quantitative.
Yeah.
Look, quantitative, we look less on that. It's more a starting point, because these are, of course, backward-looking criteria. So we pay a little bit less attention to that when we select funds. So they reflect more, if you understand the style and then the process. They're reflecting that, but they're telling you a little about how those products will do going forward.
Sure. As this question is probably a bit less relevant to you, Oliver, maybe Gavin, you can tackle it as well.
Yeah. So, I mean, Morningstar, we have 125 fund analysts. We have 50 quant scientists, quant analysts. We spend a lot of money and time and resource going into doing fund research. And the 3 key pillars to our investment process are the people, parent, and process. And the process, Shimon's talked about it, but it's the portfolio construction, it's the investment philosophy, it's the diversification. Are they constructing a portfolio in line with their investment philosophy? Are the people managing it? Is there a good team around them? Is the parent group supportive of them? So when we do our analysis, it's all of that qualitative stuff comes into the mix, and we need to know those managers through the cycle. Some of the quantitative stuff we look at in terms of things like drawdown. How significant is the drawdown? What's the risk return profile? Obviously. But also the diversification. If I think of recent scandals in Europe, Wirecard is a great example of that. There are many fund managers who put a lot of money, more than 10% of their funds in Wirecard. They thought this thing was the best thing ever. And whilst optically it looked good, we now know that it was significantly built on fraud and accounting structures and cash that just wasn't correct. So understanding the fund manager's process, understanding their resources, have they got the level of analysis required, particularly in these new industries? That is critically important to us. And so that's what we make sure our 125 fund analysts are doing every day of the week.
I'll just jump in with one thing, Nigel, that I look for, I want to hear is whether the fund manager invests in his own fund. So if we have a fund manager meeting with an active fund manager and he talks a great spiel for 1 hour about how he has the best fund in the world, but then he doesn't invest any of his own money into it, it's very frustrating, and it's not a great sign that he doesn't have confidence in his or her own ability. So investing in your own fund.
Good point, thank you. And I'm just going to rattle through a couple more questions before we finish. How much of a factor does a manager's strategy's AUM have on selection? I've heard that there tends to be an AUM size that it's a sweet spot for generating excess return. I appreciate this might vary from strategy to strategy, but who'd like to tackle this question?
Yeah, I'm happy to give it a very quick go. I mean, obviously, it does depend on the asset class. Obviously, if you're investing in fixed income strategies and government bonds, that's very different to emerging market equities. It depends also on the investment style. So if you're a long-term buy and hold investor, then yes, you can build up. You can manage more money in those strategies. So there's a lot of factors that go into that. However, it is statistically fair to say that most managers, on the assumption they're good, most good managers, and then they survive, will deliver a significant element of performance in their track record in the early part of that fund's life. I certainly was a beneficiary of that myself. So in a smaller fund, you can have greater impact earlier on. And I think that's where it's critical to understand the resources that are in place around the manager. Bigger teams can manage bigger pots of money because they can understand and do more due diligence and oversight of the companies that they're invested in.
Great, thanks. And this is a question for Oliver and Simone. What's the year been to date for multi-asset / flexible funds? Did they deliver on their promise to be all-road investments?
Okay, so I'll quickly start, and then Shimon can jump in. I think as long as you stayed invested in that multi-asset fund, you probably would have had a return of a low single-digit negative loss year to date. I think all multi-asset funds, no matter how conservative they were down on the first quarter because there was a certain point when not only stocks were selling off, but also bonds, even the safe haven US Treasuries were selling off at one point. So even the most conservative multi-asset funds had a rocky ride, but staying invested, you should have done okay.
Okay.
Yeah, I think Oliver is right. I think it's not necessarily about the returns. It's about the discipline that those multi-asset things bring. I think the challenge in the retail space is, as Oliver and Gavin mentioned, a lot of clients who will often buy on the top and sell on the bottom, and they don't necessarily have the discipline, and multi-assets to bring that discipline to the investment.
Okay, great. Just one final question. I'm sorry if we haven't managed to answer everyone's questions, but we will come back to you after this webinar. If you look at the funds industry, it's well known that the market penetration is very low in the Middle East compared to, let's say, developed markets or emerging markets. What do you think needs to change in order for mutual funds to be more accepted? So who'd like to take that question?
Yeah, I'll start. So I think it's about educating RMs, educating the end clients that mutual funds are a safer option for your money than a single name bond or stock. Where I am right now in Dubai, it's right next to the Sheikh Zayed Road that many people on this call are going to know. We drive down the Sheikh Zayed Road, we see all of these skyscrapers and beautiful buildings being built by Damac and other local market names. But there is single company risk if you invest in a single name bond or stock. And so the beauty about a mutual fund is it takes away that risk and probably gives you a similar return as you would have in that single company.
Great, thank you. Simone, do you have any thoughts you'd like to add?
Sure. No, Oliver's absolutely right. I think something we've seen here in this region is a very strong home bias. So clients, because they're familiarized with the names surrounding them, they think those names are potentially better investments, and that gives them comfort investing in them. So we've seen much larger investment directly into equities and bonds that would be in other parts of the world. I think concept of mutual funds has been only picking up in the last maybe 5 to 10 years, while it's extremely established in the other parts of the world. So yeah, I think education will play a huge part to addressing those issues.
Okay, great. I can't resist this new question that's just come in. What are your preferred strategies or funds for the second half of 2020? So I think this is relevant to all three of you. So maybe, Gavin, you can kick off with that.
Yeah, so I mean, it's very tempting to carry on with the same trend because it's been very powerful. I would say back to sustainability and ESG, I don't see this. I think this is a long-term trend, certainly a medium-term trend until every fund manager in the world claims they are ESG. I think that trend will continue. So that means that there will be a steady flow of assets into sectors and parts of the market that are not economically sensitive. What I would just make the point is that the difference in valuation between certain growth areas of the market and value areas of the market has never been, the difference has never been higher. And in certain sectors, that is anomalous, and I suspect that will reverse over the next, say, 18 months, which means that certain high-quality value managers probably are the place to certainly have a portion of your assets.
Great, thank you. And then Oliver and Simone.
Yeah, so from our side, it would be EM. And I think EM is still one of the few places where active fund managers make sense because it's a less covered universe, and there's you can add value more easily in EM. And within EM, the biased answer would be MENA, because MENA has lagged the rebound compared to, say, US, Europe, and even China more recently, which has started to rebound quite strongly. And so with very attractive valuations in MENA, stabilizing oil price, policy support coming through, I think it's a decent time to have some exposure to this part of the world.
Yeah, unfortunately, the line's breaking up a bit. Maybe, Simone, you could just step in here.
Sure. Well, I would actually stick to quality growth. We've been already in a slow growth environment, and even when we address COVID issues, I think we are just going back to the slow growth environment. So I will stick to quality growth. We like US, we like the sort of tech and all those disruptors, and we think they will continue doing well.
Great, brilliant. Well, that's a wrap this end. So thank you, gentlemen, Gavin, Oliver, and Simone, for all your time. And thank you to everyone who's been watching. I'm sorry, as I said earlier, if we haven't managed to answer your questions, but we will by email. And if you are still watching and would like to add some additional questions, then please send an email to info@insight-discovery.com. So once again, thank you very much for your time